Number 1. Define and explain thoroughly what is credit. Credit is the ability to borrow money or obtain goods and services with a promise to pay for them later, usually with interest. When someone extends credit to you, they are essentially lending you money or allowing you to defer payment for a purchase. This can take various forms such as loans, credit cards, or line of credit. Credit allows individuals and businesses to make purchases and investment they otherwise couldn't afford immediately, enabling them to manage cash flows and make larger transactions over time. Number 2. Describe the credit economy. Credit economy refers to the portion of an economic where borrowing and lending activities play a significant role in driving economic activity. In a credit economy, individuals, businesses, and governments rely on a credit to finance consumptions, investments, and government expenditures. The availability of credit influences consumer spending, business investment, and overall economic growth. Financial institutions such as bank, credit unions, and non-bank lenders play a crucial role in facilitating credit transactions and managing the credit economy. Number 3. Enumerate and explain advantages and disadvantages of the credit economy. Advantages. First is the access to capital for individuals and business to make purchases and investments. Number 2, stimulates economic activity and growth by enabling consumptions and investments beyond current income levels. Number 3, provides flexibility in managing cash flow and financing large purchases over time. Disadvantages. First is the risk of over-indebtedness and financial stability if borrowers cannot repay their debts. Number 2, potential for predatory lending practices and exploitation for vulnerable borrowers. Number 3, can contribute to economic imbalances and financial crisis if credit is mismanaged or excessive used. Number 4, enumerate and explain the foundation of credit. So, the foundation of credit are based on the trust, risk assessment, and contractual agreement between lenders and borrowers. Number 1 is the trust. Lenders extend credit based on their confidence in the borrower's ability and willingness to repay the borrowed funds. Second, risk assessment. Lenders evaluate the credit worthiness of borrowers by assessing factors such as income, credit history, assets, and liabilities. Last one is contractual agreement. Credit transactions involve formal agreement outlining the terms and conditions of the loan or credit arrangement, including interest rates, repayment schedules, and penalties for the non-payment. Number 5. Enumerate and explain the basic characteristic of credit. The basic characteristic of credit are: first is the borrowing. Credit involves borrowing funds or obtaining goods and services with expectations of repayment. Second, repayment. Borrowers are obligated to repay the borrowed funds, usually the interest, according to the terms of the credit agreement. Third is interest. Lenders charge interest on the borrowed funds as compensation for the risk and opportunity cost of lending. Number 4, creditworthiness. Lenders assess the creditworthiness of borrowers based on the factors such as income, credit history, and assets. Lastly is flexibility. Credit provides flexibility in managing cash flow and financing purchases over time. Number 6. What is a credit card, and explain its advantages and disadvantages. So a credit card is a payment card issued for the financial institution that allows cardholders to borrow funds to make purchases with options to repay the borrowed amount in full or installments, typically with interest. Advantages of credit cards. Number 1, convenience. Credit cards offer a convenient payment method for purchases in person, online, and internationally. Second is reward. Many credit cards offer rewards programs such as cashback, travel miles, or points for the using of card for purchases. Third one is the build credit history. Responsible use of credit cards can help individuals establish and improve their credit history and credit score. Disadvantages of credit cards include: first is the high interest rates. Credit cards often come with high interest rates, especially for revolving balances, which can lead to expensive debt if not paid paid off in full each month. Second is temptation to overspend. Credit cards can make it easy to overspend and accumulate debts beyond one's ability to repay.
Thank you for watching.